In September 2008, a 158-year-old bank collapsed, filing the largest bankruptcy in history with over $600 billion in assets on its balance sheet. Trillions of dollars were wiped out from retirement portfolios globally, and over 8 million people in the U.S. alone eventually lost their jobs. But the craziest part? It all started with a lie so simple it could fit on a single billboard. Why rent when you can own? Back then, Wall Street treated houses like monopoly money. If you had a pulse, you got a penthouse. Today, I am breaking down exactly how they broke the global economy using rules a 5-year-old can understand. Because the biggest lesson from 2008 is not that crashes are easy to predict. It is that financial systems look the strongest right before hidden weaknesses get exposed. If you want to understand how the modern financial world actually works, and how to protect your own money from sudden volatility, you need to see how the game is rigged. To understand how we got here, we have to look at the economy like a neighborhood candy store. Usually, if you want candy, you need to show the store owner your allowance money. No money, no chocolate. Simple. But in the early 2000s, the neighborhood got hit with a major storm. The dot-com tech crash and 9/11 sucker punched the economy. The store owner, the Federal Reserve, got worried that kids would stop buying things entirely. So they aggressively slashed interest rates to get money moving again. Borrowing money became incredibly cheap, and suddenly everybody's favorite national pastime was not baseball anymore. It was buying houses. Imagine a guy walks into a bank. Let us call him Bob. Bob makes 40 grand a year. He wants a luxury condo worth $500,000.
In any normal universe, the bank laughs him out of the room because his income cannot support the loan.
But back then, banks relied on flawed mathematical models and a blind faith that housing prices would always go up. So the bank officer says, "Congratulations, Bob, you are approved." No income, no job, no assets, no problem. They actually called these ninja loans. Even though borrowers still needed a basic credit score, the banks completely stopped verifying actual income or assets. And if you ask why the bank was not worried about Bob paying them back, their logic was simple. If Bob cannot pay us, the house is probably worth more now anyway. We will just take it and sell it for a profit. It was a total gold rush. Normal people with minimal savings were approved for multiple mortgages. Traditional lending standards were launched straight out the window. But behind the granite countertops, a dark secret was brewing. These high-risk loans given to people with unstable finances were called subprime mortgages. Think of a subprime mortgage like a rotten apple. If you try to sell a single rotten apple, nobody is going to buy it. It is too risky. So Wall Street came up with a financial magic trick. They took thousands of these rotten apples, stuffed them into a massive cardboard box, wrapped it in beautiful gold tinsel, and called it a mortgage-backed security. Then they took it to the independent judges who grade investments, the ratings agencies. These agencies score financial products from AAA, meaning perfectly safe, all the way down to junk.
But how did rotten apples get a perfect score?
Here was the structural flaw. The ratings agencies were actually paid by the very banks whose products they were grading. If one agency refused to give a box of mortgages a top safety rating, the bank would simply take their multi-million-dollar business to a competitor down the street. So the judges stamped the boxes AAA. Wall Street then sold these packages to retirement funds, pensions, insurance companies, and investors worldwide, claiming they were as safe as government bonds. They even blended the leftovers into even more complicated structures called CDOs, collateralized debt obligations. Through financial alchemy, radioactive garbage was treated like investment-grade gold. But a small group of outsiders looked past the shiny gold tinsel and actually read the mortgage documents inside. These rogue investors were known as the shorts. They realized the entire housing market was a giant bubble propped up by fake AAA ratings.
So what did they do with that terrifying secret information?
They did something that seemed completely crazy. They placed massive bets against the global housing market. Wall Street laughed at them, fully convinced that real estate could never possibly fail. But the shorts just waited for the bomb to explode. Starting in 2004, the Federal Reserve began steadily raising interest rates to cool down the roaring economy. By 2006, the cumulative weight of those rate hikes caused the slow-motion collapse to begin. Suddenly, the adjustable interest rates on Bob's mortgage reset, and his monthly payments doubled. Bob could not pay. At the same time, the massive supply of new houses outpaced buyers, and home prices began to drop. Bob could not even sell the house to cover what he owed. At first, it was just a quiet trickle of defaults in a few states. But because Wall Street had laced these loans through every major financial product, that trickle turned into a global tidal wave. Those perfectly safe gold boxes were exposed as financial plutonium. Over the next 2 years, the cracks widened until September 2008, when Lehman Brothers imploded. Because no bank knew how much toxic waste their competitors were holding, panic paralyzed the entire system. Interbank lending nearly froze, as banks completely stopped trusting each other. The global credit markets froze solid. While the world burned, the shorts became billionaires, proving that looking past the illusion pays off. Think of credit like the electricity running through your house. If the power cuts out, it does not just affect the TV, the fridge stops, the lights go out, everything jams. Regular businesses could not get normal short-term loans to make payroll. Portfolios were crushed, and everyday citizens felt the secondary shockwaves through sudden layoffs and foreclosures. To save the system from a total economic heart attack, the U.S. government stepped in with the Troubled Asset Relief Program, pouring roughly $700 billion into struggling financial institutions. The system survived, but it left an entire generation with a deep understanding of how fragile things can truly be. Now, why are we talking about this today? Today's economic risks look different. We see elevated global debt, commercial real estate pressures, and tighter credit conditions. That does not guarantee a sudden crash, but it does mean economic fragility is rising. The goal is not to predict the exact day a market shifts, but to make sure your personal financial system is resilient enough to handle volatility when it happens. Here is a 3-step blueprint to build that resilience. Step 1. Lower your fixed structural costs. In a shifting economy, cash flow efficiency is your primary defense line. Expensive consumer debt, like credit cards or expensive car loans, drains your liquid cash at the exact moment flexibility matters most. By aggressively paying off consumer debt now, you lower your baseline monthly survival cost, making you much safer if the job market tightens. Step 2. Build a flexible liquid reserve. The old financial advice says to keep just a tiny emergency fund, but during periods of wider economic strain, asset prices like stocks or real estate often experience deep discount corrections. If all your wealth is tied up in volatile investments, you might be forced to sell them at a loss just to cover immediate expenses. Keeping a robust liquid reserve in a safe, accessible vehicle gives you a safety net, while positioning you to comfortably purchase high-quality assets if prices drop. Step 3. Build strong defenses into your system. The strongest financial frameworks are not the ones optimized for perfect economic conditions. They are the ones specifically designed to survive imperfect ones. In 2008, massive multi-billion-dollar funds broke because they relied on a single point of failure: the assumption that real estate could only go up. Look at your own financial life and ask yourself one question. If the economy gets worse for 12 months, does my system break? If the answer is yes, you are fragile. True security means eliminating single dependencies. Distribute your capital across completely independent institutions. Ensure your income stream does not rely entirely on a single client or employer, and hold a mix of liquid cash, traditional equities, and tangible assets. The biggest lesson from 2008 is not that we should live in fear of the next economic downturn. It is that true financial security belongs to the people who do not buy into hype, who look past the simple billboard slogans, and who build a foundation strong enough to withstand the unexpected.